Today is a brutal day in the stock market. A ton of stocks are down anywhere from 10% to 5%, 4%. It's a bad day. A lot of stocks are selling off. Netflix is continuing to sell off after the giant drop it had yesterday. So in this video, we're going to go over what is happening in the stock market and some important things to know, because I know a lot of people are probably looking at stocks and seeing them tank down and thinking about selling or doing some other things. So in this video, we're just going to talk about what has been historically the smartest things to do in times like we're in now. So like I said, stocks are tanking down. Netflix is down significantly. DraftKings, Zoom, Facebook, everything. Everything is tanking in a giant way. And I'm sure a lot of people are considering selling their stock positions, which, if you want to sell your stock position, by all means, go for it. It's your position. Historically, it is not a smart idea to do that. So I pulled up a little PDF, research document that I like to reference. And basically what this small study shows is a 15-year period on the S&P 500, and it shows what happens if you just missed some of the best days in the market. So for example, if we are looking at, let's say, Zoom right now. Zoom is down significantly from where it was a couple months ago. It has a high of around $588, and right now it's around $100. It's down big time. And some people are probably thinking about selling it, but the problem is that a lot of times when we see giant moves to the downside, they're normally followed by very large moves to the upside shortly afterwards. For an example, if we look at the S&P 500 back in April and May and late 2020, obviously the S&P 500 have had one of its largest, most significant drops in history, but it was also followed by one of the quickest recoveries in history. And that does not mean that every single stock crash will be like this, but it goes to show you that when we have a lot of volatility to the downside, oftentimes we also see a lot of volatility to the upside shortly afterwards. So if you think you're going to be able to sell your stocks and then hopefully buy in at a later point in time, you might get lucky, but you also run the risk of missing a giant pop back up. And here's what can happen if you do miss just 1, 2, 3, or 5 of the best green days. So basically what this chart shows is what $10,000 invested in the S&P 500 from December of 2006 to December of 2021, how that would have performed over that 15-year period. So if you would have just stayed fully invested in the S&P 500 for that 15-year period, your 10 grand would have turned into a little over $45,000. If you just missed the 10 best days, instead of having $45,000, you would only have around almost $21,000. That is a significant difference by just missing the 10 best days. If you would have missed the 20 best days, your 10,000 would have only turned into 12.6 thousand instead of the 45.6 thousand that it would have turned into if you would have just stayed the course. If you missed the 30 best days, you would have actually lost money by investing into the S&P 500 over a 15-year period. That is crazy, okay? If you missed the 40 best days, you would have lost almost half of your money. So it goes to show you that especially when you're in times of extreme volatility like we're in now, historically speaking, it's not a great idea to sell off. And this is the S&P 500, so it's definitely different when you're comparing to individual stocks. But as long as you're holding good companies that you believe in, that are truly good companies, even if they tank down in the short term, you should be good over the long term. Now, there are some exceptions to that. Like, for example, if you're holding Nikola, which is a scam company, you might want to be a little bit worried. But if you're holding companies that are truly growing, that are powerhouse companies that you believe in, and that, like I said, that are good companies, even if they tank down in the short term, you should be fine over the long term. So when you're looking at these stocks that are down significantly, while it hurts a ton and while it sucks to see your favorite stocks tanking down, just understand that in the midst of chaos, there is opportunity. You guys know I love DraftKings, and it has been brutal over the past year, especially, as all growth stocks have been. And while it sucks to see the stock just tanking down almost every single day, in the grand scheme of things, you know, if you plan on investing into whether it's DraftKings or any other company out there that you like, you know, if you think about it through the long term, I feel like 5 years down the line, 10 years down the line, or maybe even a year down the line, we're going to look back at this crazy market environment that we're in now, and a lot of us will tell ourselves, I'm glad I bought the dip, right? And that's just me with DraftKings. Like, just because I like DraftKings doesn't mean you guys have to. Like, there's thousands of different stocks out there. DraftKings is just one of my favorites, and it's just one of the ones I talk about the most. So that's why I chose to use it as an example. But you can say the same thing about any stock that is actually a good company. But all in all, while these types of markets absolutely suck, and while it does hurt, remember that try to make decisions based off of logic rather than emotion. I know the stock market is a very emotional place, both the upside and the downside, but normally making the emotional decisions in the stock market is not a good idea, because people love to sell when stocks are going down and buy when stocks are going up, when in reality, even though it's harder to buy when stocks are going down and sell when they're going up, that is the more logical thing to do. So I hope this video helps some of you. I know when stocks are crashing, it definitely hurts, but just think about it this way. We just looked at a small study of a 15-year time span on the S&P 500 through one of the largest bull runs in history. If you would have missed just the 30 best days of the S&P 500 over a 15-year time span, you would have lost money. It goes to show you that if you're making long-term investments, you just gotta stay the course and you just gotta hold. You know, that's if you're making good investments. So, you know, hopefully this serves as a learning lesson, and hopefully this video prevents a lot of people from making unnecessary mistakes. But thank you guys so much for watching today's video. Be prepared for more market volatility. We're set for a very big earnings season coming up. We have Apple, Microsoft, and a lot of other giant companies reporting next week. So while the market is volatile right now, it's only going to get more volatile, and that doesn't necessarily mean to the downside. It can, but volatility works in both ways. So again, thank you guys so much for watching. If you learned something, make sure to subscribe. Besides that, have a great rest of your day.